characterized by currency depreciation, tight liquidity, limited access to long-term funding, high cost of doing business and compliance, high cost of compliance, and continue to operate in a highly competitive environment. Despite all those challenges, the business performed well. Sales volumes grew 11%. Sales volumes grew 11%, and the business returned to profitability. I think most of you remember the interim results where we posted a loss, but we are happy to say the business returned to profitability. Our market share for raw milk remained at 34%, and we also recorded growth in US dollar collections. Our brands remain very strong in the market, and we continue to support them with innovations. 2024 is not looking any better for now. It started very challenging. There were new tax measures that were introduced by the Minister of Finance, key of which was the sugar tax and other VAT-related taxes that came through. Policy uncertainties, we continue to wait for the monetary policy statement, but we hear that it's going to be happening very soon, so everyone is waiting for that. The currency continues to depreciate. Our Zimbabwe dollar continues to depreciate against the US dollar. However, we are still very poised to grow compared to last year, and that growth is going to be underpinned by raw milk supply growth, capital investments, and we will be maintaining financial discipline. We will continue to invest in technology, and our research and development team will continue to enhance our product offerings, and we will increase our regional output. I am going to unpack a lot of those issues as we go into the presentation. I am not going to talk a lot on the trading environment because I'm speaking to the converted. You know the trading environment better than me. But suffice to say, inflation did obviously affect disposable incomes. Every time that the Zimbabwe dollar depreciates rapidly against the US dollar, you find demand being affected because people's purchasing power is eroded. The geopolitical conflicts also did have an impact on our business in terms of supply chain. It affected lead times of capital equipment. We've experienced significant delays in terms of the capital equipment that we purchased, but also in terms of raw and packaging materials, mainly coming from Europe. Those were the materials that were largely affected, and I think about 20% of our raw and packaging materials are coming out of Europe. Milk supply, the Agri-Services Department of the Ministry of Agriculture reported an 8.78% growth in raw milk production in 2023 to about just under 100 million liters. Some significant growth that is happening, courtesy of the investments in the dairy industry. Foreign currency, there were disparities in terms of the rates, parallel market rate, official exchange rate, which then affected the route to market, mainly the modern retail channel, which was affected in terms of pricing distortions that arose. So it did affect our route to market. The 25% surrender requirement on exports make exports very uncompetitive. So that had an impact on exports and financing. Long availability of long-term financing is limited, which then affects our ability to invest in capital equipment. Just a summary of the dairy industry in perspective. The milk as a business accounts for about 28% of our sales volumes, liquid milk, so milk still remains a very critical component of our business. And like I said, national production for 2023 was 99.8. Of that 99.8, we received and utilized 34% of that. And that number is coming from a peak in the 1990s where we used to receive 256 million liters. In 1990, intake was 256 million liters. That number significantly went down in 2009 to 39 million liters. But we are recognizing the increase that is happening in terms of raw milk production from 39 million in 2009, and we are now sitting at 100 million liters. And we are continuing to see that trajectory in terms of growth. There are about 50 processors to talk about in the dairy industry, and we received the 34%. I think the opportunity that is clear from that slide is that per capita consumption is at about 8%, 8 liters per person per year, which is very low. Historically, that number used to be at about 25, and when we look at regional cooperatives, they vary from 25 to 40. So South Africa is currently at 40. So there are opportunities for us there to say, how do we grow our per capita consumption to the 25 that was there. The cost of raw milk, however, in Zimbabwe still remains a challenge and a threat for the business and the industry at large. Not only just for Dairibord, but for the industry at large. We currently are paying an average of about 60 cents per liter of raw milk. South Africa is at 40 cents, and it goes up to about 43 cents. Malawi is at 26 cents, Zambia is at 43 cents. If you go up north to Uganda, they pay about 18 to 20 cents. So the threat then comes in to say, how do we reduce that cost of growing raw milk in the face of the Africa Free Continental Trade Area? Because if the borders, when the borders open and we are still at 60 cents, it then becomes a very uncompetitive space for us. So industry collectively is working to try and reduce that cost from 60 cents to about 50. And we are hoping we'll be able to do that, although the drought will not help in this year. We are now looking at the 23 performance summary, just some highlights there. Raw milk intake, our raw milk grew by 10%, which was better than the 8.78 national growth. It's representing 34%, so we still remain the dominant player in the raw milk space. Our volumes grew 11%, largely driven by growth in beverages and liquid milks. The foods category experienced a decline, and we'll talk a little bit on that. About 84% of our revenue was in foreign currency, up from 58% in 2022, which was a nice increase from the previous year. Exports grew marginally by 1%, but I must say for us, the growth was really stunted as a deliberate move, because the export market is less profitable than the domestic market. So we ended up prioritizing the domestic market because of limited capacity. We were then not able to meet the demand for both the export and the domestic market. That's why that 1% is stunted. But we have a plan to try and improve on that export performance. We commissioned capital projects worth about $4.1 million in 2023. The key issues there were cost reduction and revenue enhancement. And for revenue enhancement, we commissioned a third Maheo filler at Chitungwiza, which increases our capacity. And we also commissioned a blow molder at Chipinge to increase the stirring capacity. The refurbishment of the Rekaitambe chilled water plant was an efficiency enhancement project, and a cost reduction project. And also, together with the water storage tanks, we commissioned 1 million litre reservoirs at our 3 factories of Harare, Chipinge, and Chitweza, so as to reduce the cost there of water. These numbers, which are the financial highlights, are the audited numbers. I can see our audit partner charities here. The audited financial statements are the inflation-adjusted numbers. We got a clean audit for year 2023. These are Zimbabwe dollar numbers, because when we did our assessment of functional and reporting currency for 2023, the board agreed that it was the Zimbabwe dollar. But going forward, the Zimbabwe dollar, with effect from 1 January 2024, the United States dollar then becomes our functional and reporting currency. But for 2023, it is the Zim dollar in both the inflation adjusted. The historical numbers are not audited, they're just there as supplementary information. The good points there are to say the revenue, we've already spoken about the volume. So the revenue growth was really a function of the volume growth and price adjustments to try and restore margins. However, we experienced the crystallization of expenses in 2023 when people were now migrating from Zim dollar expenses invoicing to US dollar invoicing. So our costs increased, but I'm happy to say the growth in costs was slower than the growth in revenue. However, in those numbers, there is 60 billion, in the historical numbers, there is 60 billion relating to foreign exchange losses that we incurred during the year. So 30 billion of that is in finance costs and 30 billion is sitting in the operating profit. So there's about 60 billion there that relates to exchange losses. In inflation adjusted numbers, that number is 93 billion. So I think the point that is coming from those numbers is the disparity between the functional currency and what is happening on the ground. So, because if you end up with 93 billion as exchange losses, I think it speaks to some disparities in the currencies. So what we then did is, in terms of tracking our business and saying, how are you performing as a business? We obviously also use US dollars to track the performance of the business. However, when you look at 2022, because 54% of our business was in Zimbabwe dollar, it obviously brings in exchange rate issues and conversion issues. But we are happy to say this is a very close estimate of how we think the performance of the business was in 2023 and also in 2022. The selling price, when you look at the selling price there, moving from 95 cents to 107 cents, the 107 then reflects the stability of the invoicing currency. As opposed to when you are invoicing in Zim dollars, you are then able to convert that, the rate is changing every day. What exactly is your selling price for the day or for the month? It creates its own problems. But we are happy to say the 107 is a very clear indication. And when we look at our performance so far, January to March, our average selling price in US dollars is also around that same number of 107. I must say the margins were maintained with almost the same levels. The profit before tax margin was higher at 6% and versus to 4% in 2022. I think most of us remember that 2022 was affected by the 200% interest bills. So the interest bill at that point was very high. But at the operating and gross profit levels, we have maintained the operating profit margins. I must say that the best Dairibord, the best operating profit margin that they posted was about 12% in about 2012, there around. So we are still trading that, but we are happy to say as now the currency is stabilizing, we should be able then to see that performance coming back to those levels. at the highlights in terms of the financials, the business is really anchored on these brands. We are happy because we've got a very diversified product portfolio. Diversified in the sense that we do have ambient products which allow us to reach broad markets because they are ambient products, but we also have your cold chain products, which is your yogurt there and lacto. But most of our products, we're able to say they are ambient products, and also the ice creams. Most of the other products, we're able to say they are ambient, and we're able to distribute them. This is what the market says about our brands. It's not us, but I think it's confidence of the strength of our brands coming through. Cascade Baobab was a top 3 finalist in the International Dairy Federation, World Federation of Innovation. And from the Super Brand Awards, Fugo was first in those booths, and then there were 2 others. In the milk category, the first one was Chimombe, the second one was Lacto, and then the others came after that. On non-alcoholic beverages, Cascade came as second runner-up after Coca-Cola and Pepsi, which speaks to the strength of those brands. Our tea, the Quick Brew brand, came in as the second runner-up after Tangana and Stella. So it's testimony of our strong brands. Our research and development continues to work in innovating our products. We brought in Dairibord, that's a new addition that we brought in last year. We also brought in Natural Joy, and we also brought in Fugo in Ginger. The market has very well received those products, and we are happy with the performance so far. So that is just showing the trend in terms of our volume performance. And we've gone back 5 years, and it's showing a very nice gradual upward trend, except for 2020, which obviously was affected by COVID. But we are happy that the trend is a good trend. And also the same ones on our exports. And like I said, the exports are really constrained because of margin considerations. So we kind of almost kept the exports for 2023. But we now have a plan where we are going to make sure that that export number continues to go up. In terms of our portfolio, liquid milks grew 8%, and that number was almost very aligned to the growth in raw milk intake that we talked about, 10%. The beverages grew by 18%, and the foods declined by 21%. We obviously are not happy because of that 21% decline, but there were a number of issues that came into play in the year 2023, one of which was the authorities allowed duty-free imports of condiments. So condiments were coming in from South Africa duty-free, and because Zimbabwe is inherently a high-cost manufacturing space, we couldn't compete on price, but we are happy to say that we were competing on quality. The other product that was also affected there is the ice creams. Ice creams are affected because of the issues happening with the electricity. So demand for ice creams goes down. And the disruptions that we suffered in the route to market. The modern trade channel was very much affected by the exchange rate issues. So most of the times we're not available in that space. And the food is one category that is mainly sold through the modern trade, because that's where you have your ice creams, you have your yogurt, and the modern trade is your channel that is called the cold chain that is already installed there. And also the other products like your salad cream, tomato sauce are also mostly sold through the modern trade. So that is what happened on the food category. But we are looking at that to say, how do we continue serving our consumers through the other existing channels that are available to us. In terms of the volume contributions, liquid milks remained at 28%, beverages grew to 65%, and foods went down to 7%. But it's something that we are working on. So this is just a view of the channels that we go through. In 2022, the retail channel accounted for 15%. That number went down to 11% in 2023. And the other channels remained almost at the same levels, but your general trade going up from 25 to 28, and also the wholesale channel going up to 28. So despite what was happening on the modern trade channel, our products still found their way to the consumers through those other channels. So we have quite a kind of diversified route to market in terms of our channels, which eliminates some of the risks that we face in the modern trade channels. I am not going to spend time on the financials because, like I said, these are $0 numbers and they are already on the website and they are audited. So we've just provided them there for information. Leonard is here to explain further if there is need for any explanation, because they are already on the website anyway. But suffice to say, the key ratios, the key performance indicators that we are showing there have maintained. So when you look at the operating profit margin, if you take out the exchange losses, that EBITDA and OP margin, they go up to about 16-17% if you take out the foreign exchange losses. So that was the performance of the business, breaking even almost in inflation adjusted terms. It's a bit of a profit there in the historical terms. The statement of financial position, I think the key issues that are there are the balance sheet is very liquid. The way cash, in terms of the cash and cash in hand, about 89% of that was in US dollars. The balance is what was in Zimbabwe dollar, because we still were selling in Zimbabwe dollars. On the statement of cash flows, they are positive from the operations, but suffice to say the delays in lead times have really affected working capital in the sense that the working capital cycle is now very long. Most of our foreign suppliers required to pay it in advance, and when they ship products and there are delays on the seas, it means the working capital cycle is very long. 30% of the inputs that we use in the business is imported, which then speaks to any impact of the delays on the supply chains on the working capital cycle. In terms of the borrowings, we had a combination of both US dollar borrowings and Zim dollar borrowings. US dollar borrowings we had with about just over 4 million at an average interest rate all in of 12%. I can see some of my bankers are here. They've really been supporting us. And also we did have some Zim dollar borrowings. Average interest rate there was about 80%. Most of that money was short term, but there are some long term amounts in US dollars. I think 1 million, yeah, this is long term, and in the Zimbabwe dollars about 4 billion rather was long term over 3 years. So we did have some bit of long term funding in that space, but most of it was short term money. The gearing ratio at 13% in inflation adjusted terms and 19% in historical terms gives the business an opportunity to leverage on the balance sheet for capital expansion. So that gearing there for us gives us an opportunity to grow the business. Yeah. Because of the capital projects that are lined up, we really want to grow the business, and for us to grow the business, we need to invest in additional capacity. So, because of those requirements, and also for 2024, we are looking at growing our volumes. So the board then resolved that we do not declare dividend for the period ended 31 December 2023. 2024 outlook and opportunities. Like I said, the year started with significant changes to the business, one of which relates to the taxes, the sugar tax that was pronounced on the 1st of January. It came in on the 1st of January at 0.002 per gram. And then the minister on the 8th of February announced that after engagements with industry, announced that that number had been decreased to 0.001. So for us then to be able to recover that sugar tax, we had to adjust prices. But because there's price resistance in the market cannot absorb disposable incomes are low, we couldn't pass through 100% of that sugar tax to the consumers. So there were some price adjustments, but not 100% price adjustments, and we are hoping that we will be able to maintain and grow our profitability through volumes as opposed to price. The market is now very price sensitive. There were other changes in VAT, one of which was milk was moved from zero rated to exempt. What that means is the cost of producing milk obviously increased because we are not able to claim the input tax that relates to the inputs for liquid milks. But on Maheu, then moved from exempt to vatable at 15%. What that then means for us is we are able now to claim the 15% that we were not able to claim previously. So there was a mixture of things that happened on the taxes. But what we have said and what we are doing is our research and development is continuously looking at our products and saying what can we do to reduce the cost to the end consumer, but without compromising the product quality. We are very sensitive of the product quality and what it means to the consumer. So whatever our research and development team is doing, we are not going to compromise on product quality. The minister also in his statement restricted the route to market for manufacturers. So he then said manufacturers can only sell to wholesalers and wholesalers can only sell to retailers. After some engagements between the industry and the minister, he then pronounced that because dairy foods and beverages, some of them are perishable, we can sell directly to the end consumers. I think the key issue for us from the pronouncement was the wholesalers, as defined by the minister, do not have capacity to distribute our whole range of products. They obviously need to invest a lot, which is obviously not possible. So we are happy that those engagements yielded that reprieve, and we continue to use our normal route to market channels. The Zimbabwe dollar continues to depreciate in 2024 and is depreciating tremendously. We are hoping that the monetary policy statement that is going to come soon will address these issues and bring in some stability. I think all of us what we want is stability of the currency. I'm not too sure whether anyone worries whether it's a Zim dollar or a Zig or a Taba fund. But I think what we want as businesses is to say we want stability of the currency. And that is what we are hoping will come out from the monetary policy statement. The El Nino was worse than we had initially expected. And it obviously is going to have an impact on the costs of growing milk on the farms. It's going to have an impact on cost of stock feeds. is also going to have an impact on electricity generation, because Kariba now they are saying it's now at 240. It's also going to have an impact on availability of water at our processing factories. So those are challenges that are there, but suffice to say, on milk supply, we have a very aggressive agenda. One of the things that we've managed to do as a business is to consistently pay the farmers in the right currency. And because of that, we have attracted quite a number of farmers, and our milk intake for this year is significantly increasing. In terms of water and the processing factories, we have commissioned the 1 million litre reservoirs at each of the factories. Chitungiza now has the 1.5 million litre reservoir and an additional 1 million litre reservoir, all to try and say how do we protect our processes and ensure the water is available. But the summary is that the operating environment remains very unpredictable. There's uncertainty in terms of the tax flows, because there's still engagement with the minister in terms of should we pay 0.002 for January, or should we not pay anything? So there's still those engagements with the minister. The route to market restrictions, yes, they've disrupted, but we have relooked at our route to market architecture and said, how can we ensure that we get to the end consumer without compromising our sales volumes? And we are looking at direct channels that we have deployed. The erratic supply of utilities that is with us, but we are happy to say we've got some standby and backup facilities at all our factories. We want to continue growing the business, growing the volumes, and we are going to do that through organic growth. And organic growth, we are looking at expanding with current products. Just to say, how do we make sure that food is available everywhere? Now that we have got our installed capacity, we've increased capacity, how do you make sure that you distribute the food in the width and breadth of Zimbabwe and also outside of Zimbabwe? Research and development continuously looks at that as part of the organic growth, but also as part of the inorganic growth, we are looking at expanding with new, which includes totally new products that we are looking at, to say which new products. So it's all work that we are doing, but we are also looking at saying how do we enhance our footprint in new geographies and in the region. So what we want to do is to grow exports. I think the last time that we went to the market, we explained that we were looking at all manufacturing possibilities in South Africa. I'm happy to say that we have made significant progress. Our research and development team was working with the possible toll manufacturers that we identified in South Africa to really make sure that we produce a fugo that is exactly the same as the fugo that we are drinking here. What that means is our plants are going to be available in South Africa. It's a bigger economy, it's a bigger population, and it's a low-cost model. So we will now be serving South Africa and your Botswana, Eswatini, and all those other areas from South Africa. And we are very happy with that development. I think when we get to the first half, we will then be reporting on the progress that we've made and how much we've now taken into the market. But I'm happy to say we've made a lot of progress on that. So what that will do is, obviously, it will grow our volumes. It will also provide us as a source of foreign currency. And it will also prepare us for the Africa Free Continental Trade Area, because we are then producing our products in a low-cost environment. The focus on cost containment and cost reduction is real this time because of what has been happening on prices. We are not able to 100% pass on our sugar tax onto the consumers. So the only option that then remains for us is then to say, how do you reduce the cost? So the focus on cost reduction and containment then becomes very critical. We are looking at, we have enhanced our engagement with suppliers. Supplier relationship management is now very critical. We also are continuing to increase the number of suppliers for each of our inputs. It's not possible for us to increase the number of suppliers overnight unless it is for pervasive packaging like your baler bags, which everyone uses. But if you are going to have another supplier of a food bottle, it takes a bit of a while because the person has to bring in the molds and you have to make sure you're agreeing on everything. But what we are doing at the moment is to make sure that we have multiple suppliers for all our inputs so that we reduce concentration risk. And like I said, formulations, research and development is continuously looking at that. We are very alive and cognizant of our impact on the environment within which we operate. And I'm happy to say that the Chipinge Solar project will now be starting in earnest. Godfrey and his team have now just finalized the conversations with the possible supplier of that, where we are going to be having a power purchase agreement. And so we'll start with the Chipinge one, and then we will see how it goes and then roll it out depending on the performance of that first one. We also are increasing the recycling of our solid waste in the environment. Recently, we signed an agreement with Tetra Pak, who is the supplier of our cartonized beverages. They are coming in to assist the industry in Zimbabwe in terms of collecting solid waste and recycling it in South Africa. We also still remain a member of PepsiCo's in who looks at PET solid waste, and there is a group called Sunshine Group which goes around collecting HDPE waste. Water is important and is critical, so we are looking at water recycling and enhancing efficiencies in the factories so that we continue to minimize negative impacts of our business on the environment. Ladies and gentlemen, the team at Dairibord is very committed to growing the business, growing the volumes, and we are going to be looking at huge capital expenditure. Our capital expenditure for 2024, which obviously, because of the delays, will spill into 2025, is 24 million. I think it's a very huge departure from what we used to do. But what we are trying to do is to say, let's close all the gaps that are there so that we are able to meet the demand of our nutritious foods and beverages. I thank you.
So moving on, I thought we would get a resounding round of applause for that presentation. You did clap. It was very informative, heavily pregnant with information. I'm actually not even expecting any questions at this moment. And this is happy, so the boss is. So we'll get into a quick question and answer session. If you've got a question, please just raise your hand. We'll bring a mic across to you, and then the team will respond accordingly. See, I told you, no questions.
Thank you so much for the presentation. I just want to understand what was the board thinking when they decided to report ZWL for 2023, when 84% of the sales were in USD. I understand and appreciate that going forward they will be reporting in USD, but I just want to understand their thinking in reporting in ZWL for 2023.
I will obviously then allow them to look at this, but the bigger portion of the 2023 that was going to get this graph. So when you look at the proportion of US dollar sales in the first half, I think in the first half we were below 50%. And that number then significantly increased as we went into the last quarter of the year. So yes, the average is 84, but I think the difficulty was this bigger portion where it was reporting in Zimbabwe dollars. How do you come up with US dollar numbers that the auditor had really say she has confidence? She has confidence in those numbers.
Thanks, yes. You've kept it well, but it's not only the revenue which you look at, you also look at the expenses which you are paying to the suppliers. If you are to look at the 2023, the first half, mostly it was Zim dollars. That's why our first half is suffered huge exchange losses, because we're selling Zim dollars and we're also expanding Zim dollars. So when the auditors look at that, they realize we can't say 2023 is actually US dollar, we need to report in US dollars because of that. But going forward, all our expenses, all our revenue, 84% to 90% are now in US dollars, so we can now easily migrate to US dollars. Thanks.
CapEx, how is it going to be applied? The funds, how are you going to apply?
So, Godfrey is in charge of procurement, production, all that. So I'll ask him to respond to that. But suffice to say, there's a portion for replacement and there's a big portion for new projects.
100%. So it is definitely a portion for expansion and a portion for refurbishment and maintenance of our existing equipment. I think as our GC mentioned, the big challenge we had previously was that we had a lot of very good brands which were not able to supply the market, which is that you fix by creating the capacity. So 2023 capacity started coming up, and that's why we saw the 10%. But what you realize is that most of the capex that we applied in 2023 came in the middle of the year. So we not yet even reported the full benefit of the capex that we had last year. So we're quite excited about that capacity increase that happened from the capex from last year, which we will see the full benefit this year. But beyond that, you want to get to a point, ideal situation for the FMCG is that your supply side should never be a constraint. So we want to get to a point where we are able to provide all our products in full to every single consumer who's looking for our products in the country. We are very excited about the fact that the brands are still very much favored by the consumers, as has been shown in the presentation. And it is really up to us to make sure that we supply. And that gives us really the confidence to invest in the capacity, because at least we know that our products will have a home, and because they are preferred, we are able even to take a premium on the price. And that is going to sustain our growth going forward.
Thank you. I've got two questions. In your product basket, how much of your products are sugar-based? Then the second one is, what will be the volume, the output volume that you sold last year if you strip out the Mayo, the Fuku volume? How much did you sell last year?
if you're just looking at just saying how much of your products are sugar-based, I think I would say all of them are sugar-based, except milk. So it's your liquid milks that do not have added sugar. All the other products, they have got some added sugar. So it then really depends on how much sugar, which color of sugar is it, brown or white. But all the other products outside of the liquid milks have some added sugar in them. On the Fugo, I can't remember how much is it.
So Fugo is about 40% as of last year. So that's the numbers.
Anyone else with a question?
Thank you for the presentation. Just wanted to more holistic view of how your foods division has been performing from a market share point of view when it comes to supplying your retailers and your wholesalers. Because I've seen the drop by 70%, 57%. So I'd like to understand how you now play within the retail and wholesaler sector as well. Specifically with your tomato sauce now facing more competition from exporters as well.
So the foods account for 7% of our total sales volumes. And we have now said, I've asked Chaimo to give a little bit more detail on that, but we've said, I'll now say to ourselves, the person that wants tomato sauce can buy it from anywhere. And what we are trying to do now is to take our products to the consumer. Direct channels that take us directly to the end consumer. We still remain in the modern trade, but it's an on-off situation depending on how much they've paid, how we've built them, and all that. But we are hoping that we should be able to find each other and go back into that channel. But even if we were to go back into the modern trade food channel, we still think there is merit in taking the product to the consumer, obviously taking into account the cost-benefit analysis of doing that. You obviously have to take into account the cost of distribution of getting into that consumer, which ordinarily you would then charge a slightly higher price than you would if one was going to get his or her product in the wholesalers. But we also still have a very strong presence in the wholesale channel, where a lot of people are buying from. We also are going directly to institutions, your schools, your institutions, so that we ensure that the proportion of foods grows. Where we will probably have a bit of a problem is your ice creams, which require cold chain, obviously. You then need to say, where do you get a distributor who has got cold chain facilities that's able then to distribute your ice creams. But it's things that we can work with to then say, can we get motorized scooters that are refrigerated that then go around, all those things, we are looking at them. But the key issue is just being, how do you take your product to the end consumer? Chaimo, do you want to add anything?
Thank you, Mercy. I did not add much more, but just confirmation. The retail channel, what you call the trade, remains key to us. We see it go through okay, it's powerful, they still remain key. But the current environment, the question is, how do we get faster to the consumer? How do we reduce the value chain to reduce the consumer in the face of the savings of this world? I think what you can say, you say that it's powerful, but it's powerful. It become cheaper. You will never land also. becomes volatile, it becomes cheaper. So the question is, how do you reduce the cost between us and the consumer? So modern trade will remain key, but also trying to come into market architecture where we've got direct control of ourselves to the consumer, where you'll see the revamp of our fund sales, probably our own shops. We're still working on the model, but the summary is we are trying to reduce the value chain between us and the consumer to make it cheaper, and also effective information between us and the consumer. Thank you.
Anyone else with anything burning? Okay, thank you. So I think what's left for us is to thank you once again for taking your time out to be here this morning.